Meanwhile, Lesaka has beat its profitability guidance for the second quarter of 2025. The financial technology company has now delivered on its profitability guidance for 10 successive quarters and has reaffirmed its guidance for the 2025 financial year. Lesaka Southern Africa CEO Lincoln Mali joins us now for greater perspective on the performance. Lincoln, thank you so much for your time. Now let's talk about the drivers of that top line that were so revved up that they boosted revenue to the upper end of guidance.
I think it's been a all-round performance. We've seen huge growth both in our consumer business and in our merchant business. If I can just start with our merchant business, that's up, net revenue up 68% to 854 million. If we think about EBITDA, segment adjusted EBITDA in that merchant business up 32% to 185 million. That's also been assisted by the inclusion of the Adumo business for the first quarter. So huge, performance from our merchant business. If I look at our consumer business, that's really done well. Net revenue up 31% to 411 million rands, and segment adjusted EBITDA up 61% to 77 million rand. So overall, if I look at the group, we've been able to register, net revenue of 1.4 billion rand, which is 42% up. Group adjusted EBITDA up 26% to 212 million. And I think what's heartening for me is this is the 10th consecutive quarter where we've met the guidance that we've given to the market. And really that means a lot to be able to give the guidance to the market and be able to achieve the commitment that we've made.
I actually want to dig deeper into that bottom line because, of course, you talk about the adjusted core profit that lifted by 26%, where that's been ongoing growth. But the operating income softened more than half, and the net and GOP loss increased significantly compared to the second quarter of 2024. Walk us through those differences.
Yes, I think it's important to see those as non-cash items, and they have to do with either extraordinary once-off expenses, like the transaction costs of some of the deals that we're doing. But also the one most significant event was we have an 8% stake in a business in India called MobiKwik.
Okay.
We valued that business at 1.3 billion rands, and we've carried it on our balance sheet over this while. Now, that business has been doing well to a point where it was able to list. And when it listed, now the true value of that business based on the market ended up becoming about 800 million rands. And so that difference is a difference that impacts you. But when you think forward, we now have an asset that we can be able to dispose of. We've said before that it's a non-strategic asset. It's non-core to what we do. At the right time, we'll be able to dispose of that asset. And what that will do is that we'll be able to bring, those funds to be able either to reinvest in the business or to pay down our debt. And so for many times, people have asked us the true value of MobiKwik, and now the true value is being determined by the market. So we're comfortable that if you're looking at our earnings per share, those true measures, our fundamental earnings are up 35%. If you look at those measures that do not have these anomalies, those give you a true sense of where the business is going.
Is that the only kind of non-core asset that you are looking at offloading right now? Because I know a lot of focus has been on the acquisitions.
Yes, we still have other assets that we have. And again, they may be non-core, but we are a responsible shareholder who will engage with those assets at the right time. But we want to make sure that every asset we have does add value to the business. And so we will always look at those businesses in that way. If you look at our track record over the last 4 years, we have disposed of a lot of assets that were in Europe, assets that were in Southeast Asia. And assets that were on the continent, and those assets disposal enabled us to make some of the acquisitions that
Okay.
we've made. So it's always making sure that we're in line with our capital committee that is very robust and very challenging to us to make
Yeah.
sure that we give true value to shareholders for the
Ah.
assets or the monies that they've given us.
Very interesting moves that we are seeing there in your kind of portfolio management effort. And talking about adding value through acquisitions, how much weight have your recent acquisitions added to your growth picture?
The way to think about it is that without the acquisitions, we think there's a run rate of about 25%
Yeah.
that is growth that's there. And
Okay.
so in addition to that, our acquisitions will add to that. So we've
Mm.
always seen our growth as being both organic and inorganic. Over time, some of those acquisitions, it will be difficult to delineate them within the businesses, because when they come in into an existing structure, and sometimes there are synergies, cost synergies or revenue synergies. So, but by and large, we've given a sense to the market that we will grow into financial year 2026.
Okay.
We've given a guidance of 1.35 billion rands. So
Okay.
that's positioning us for a growth. If you look at the midpoint, that's like a 42% growth year on year. So, and that includes both organic and inorganic. And
Mm.
bear in mind that if you take Adumo is only with us in this quarter. They
Yes.
were not us before. Recharger will only be with us in the next quarter. So I think it's very important to see both the organic and the inorganic as being symbiotic in the way we think of our business.
Let's touch on touch sides. I do understand that there has been a rebrand there, where it's now Kazang Insights. What's the motivation behind that?
So one of the things that we have to try and do is to simplify our business for everybody who looks at our business, to say we have a brand called Lesaka.
Yeah.
Lesaka is the group brand. That brand speaks to the media. It speaks to regulators. It
Yeah.
speaks to analysts and shareholders. It speaks to our staff and potential staff. It's not customer facing.
Okay.
Then we have these four divisions that we've got. We've got the consumer division. In that division, we now have got Adumo payouts and we've got Easy Pay everywhere. We have to simplify that so that
Okay.
in the consumer division, you have one brand that people can relate to, which is likely going to be Easy Pay. In the merchant business, we've got Connect Group, we've got GAP, we've got Adumo.
Yeah.
So again, you have to simplify it. So you'll start only having Adumo and GAP in that environment.
Okay.
And then in the micro environment, you have Kazang.
Okay.
So we are then integrating the touch sides, insights, data analytics team into the Kazang business so that the brand that customers see and engage in is Kazang. So as we buy some of these businesses, we will always try and rationalize
Okay.
our brands. It's also linked to some of the things you were asking earlier as to what is the contribution of the core businesses to versus the organic businesses versus
Yeah.
what is coming inorganically. Now, whatever you've bought starts to become organic. So you want to integrate, you want to have synergy.
Yeah.
And there are things you sort out sometimes that just make common sense. If we have got 5 websites and we're paying 5 different suppliers,
Yeah.
but we could come as one organization with the cloud to say, we'll pay a better price because you're servicing a bigger part of the business. So
Yeah.
those kinds of synergies we're able to do. And therefore, when we have to rationalize what we do, avoid duplication, and make sure that we've got brands that are customers facing that are cut more simple. So we don't want an organization that has got many brands and
Yeah.
people can't delineate what brand
Okay.
stands.
So the
Yeah,
branding integration needs to catch up to the profit integration. All right, I get you.
absolutely.
Thank you so
Absolutely.
much for your time
Thank
and
you
for your
so much, guys.
insights there. Lincoln, that was Lesaka Southern Africa CEO Lincoln Mali.